Thank you so much, and thank you for this kind of invitation and for introducing me in this kind of way. Yeah, my name is Alain Zaremba. I'm from Montpellier Business School in France, and I'm really glad with this invitation and the opportunity to present a recent piece of our research. So, Christian Gerrit and Thorsten are from University of Bremen in Germany, and Thomas Walker is from Concordia University in Canada. And so what we do in this paper, we actually matched two very hot topics recently, which is cryptocurrencies and machine learning, right? Cryptocurrencies that got surprisingly popular. I'm teaching an investment management course in Montpellier, and I ask my students every year in the beginning of the course how many of them have already invested in the stock market. So when I asked this question this year, maybe out of 50 people in the class, 2 raised hands or 3. But then when I asked them how many of them invested in the cryptocurrencies, half of the class raised their hands, right? So that's kind of surprising, since especially, I would say, investing in cryptocurrencies is really no walk in the park. I mean, comparing to stocks, we don't have here time-tested models. We don't have the wealth of data that we have for the stock markets. We don't have the history of dozens of years, literally, of financial statements and stock prices that we could test different strategies. I mean, if we don't even agree on valuation models, how should we price cryptocurrencies as how much they are worth? In fact, you know, we see voices from time to time that actually cryptocurrencies are totally worthless. So what we do in this study, we try to somehow fill this gap. I mean, how should we price the cryptocurrencies? For stocks, we do have a lot of different models that help us to tell how can we price the cryptocurrencies? How can we say whether they are expensive or cheap? Or when they can say if they are cheap or expensive, how can we say whether they will produce high or low returns in the future? Now, since we don't have this fundamental data that we do have in the stock market, in the bond market, in the form of financial statement, macro data, economic data, we need to turn to price data. And we already know that a lot of different price patterns or return patterns that exist in the stock market also hold for cryptocurrencies. Like, for example, we have the momentum effect. We know that cryptocurrencies that produce high returns in the past continue to outperform in the future, but the wealth of data coming from a wealth of information coming from past prices is much richer. So what we try to do in this paper, we try to extract as much information as possible from past prices, volumes, volatilities, and use it to price cryptocurrencies in the stock market. So by doing it, we propose a new asset pricing factor, which is called C-trend, since we deal with cryptocurrencies here, and comparing to other known or existing asset pricing factors, which are not based on machine learning, comparing to this one, it seems to perform pretty well, right? So what I will tell right now, I'll introduce you to the methodology that we employ, to the data, and I will go over the findings. So in order to test an asset pricing model, you need data. So what we do in the first step, we download all possible data on the cryptocurrencies that exist from CoinMarketCap, which is currently the broadest database that exists. Giving the time series that we use, which is like almost 8 years of data, we pull all the cryptocurrencies, filtering those which are very small ones, I mean, below $1 million market capitalization, leaving over 3,000 different coins, different cryptocurrencies, which we examine within this paper, right? Now, as you can see from the clear statistics, the cryptocurrency market is heavily biased. The distribution of cryptocurrencies is highly skewed. We have a very small number, a handful of huge cryptocurrencies that account for the majority of market capitalization, and then this very long tail of small and illiquid capitalizations with very little economic importance, but when you look at the pure numbers, there's really a lot of them. Now, we need to extract data from historical prices because there's not much else we do have in the cryptocurrencies. There's just a couple of different fundamental variables associated with networks, with the activity, with the electricity production cost. But what we are rich in terms of data is actually the prices and their past behavior. So what we do, we look for the practitioners' literature, we go to the finance literature and try to calculate a broad representative range of different technical indicators. So indicators that are based on historical prices, historical volumes, historical volatilities, and based on that, attempt to give us some clue about the possible future performance. So we have a bunch of different oscillators, moving averages, volume indicators, volatility indicators, in total 28 different variables. Now obviously not all of them work, right? If we form strategies based on those indicators, some of them really translate into substantial abnormal returns, substantial alphas, and some of them not, right? In some cases, these values are significant, some of them are insignificant, sometimes they are positive, some others they are negative. Not all of the strategies translate into some patterns. Now, how should we extract which of them work and try to extract as much information as we can without any a priori assumptions, to do it in a data-driven way? Now, to approach this problem, we turn to machine learning. Now, how can you extract as much information as possible from a range of different variables that possibly contain some information, uncorrelated or correlated, about the future returns? Now, we start with a methodology of Han et al. From 2016, who ran cross-sectional regressions. So what they did in their paper, they simply each month, or each week, each month, because that was about the stock market in that case, then regress the future returns on different past return predictive signals and attempt to forecast future performance based on the results of this regression. I mean, this idea is nice, but it couldn't work very well if you have very noisy data. And cryptocurrencies are noisy. I mean, you see sometimes returns like 1,000% within 1 week, which do not really happen in the stock market. So to deal with this kind of volatility, you need some smarter tools. Second, many of our indicators could be correlated. They can extend this method with 3 different techniques, mainly from forecast combination with regularization and forecast selection. So in the first step, what we do, you run univariate Fan-Macbeth regression. So each of these 28 or 29 variables, we run regressions and predict returns for the next month using the last 52 weeks of data. Then we apply ElasticNet, which is a very simple yet extremely powerful machine learning technique that imposes penalty on those coefficients which are not particularly important. And by doing it, we are able to shrink the number of variables to automatically select those coefficients that matter and discard those that are not important for the cross-section of future cryptocurrency returns. And finally, having extracted those variables that matter from those that do not matter for the future cryptocurrency performance, we simply aggregate them using a forecast coordination method. So we average the forecast based on univariate regressions from those variables selected using ElasticNet, right? So first, Fan-Macbeth regression, then ElasticNet, and finally forecast combination. Now, so with that aggregate prediction at hand that extracts as much information as possible from the past price data, we name it C-trend and try to predict the future returns. So how does it work? I mean, so what we do in the first step, we take all those cryptos that we have in our sample, so like 3,000 different assets, and store them in the portfolios. So the stuff that we typically do in finance. I mean, we don't have that many cryptocurrencies, especially in the early years of our sample, so we sort them into quintiles, into 5 portfolios. And indeed, there is a clear pattern. So those cryptos with the highest C-trend variable produce almost 4% per week. And those with the lowest numbers produce like 0.1% per week. So the difference is substantial without major differentiation in the level of volatility. So if you form like a long-short strategy that would buy those cryptocurrencies with the highest C-trend factor, with the highest prediction based on technical analysis, and take short position in those cryptocurrencies with the lowest C-trend factor, that would produce 3.87% per week with the t-statistics of 5.19, right? The number which seems at first sight pretty amazing. Now, if you look at this level of volatility, that yields a Sharpe ratio, so the ratio of return to volatility in the simplest way of almost 2. So again, a number that you hardly ever see in the stock market. Now the question is, can we capture it with some known existing asset pricing model in the cryptocurrency market? Can we hit it with some known factors to see whether it produces abnormal returns against what we already know? I mean, there are not many asset pricing models in the cryptocurrency world. We can hit it with the normal capital asset pricing model, cryptocurrency capital asset pricing model, which assumes that the crypto returns can move with the market movements. So if the market goes up, some cryptos goes up. If the market goes down, some cryptos goes down. But it doesn't help to explain. I mean, still this long-short strategy produces 3.8% per month with a t-statistics of 5, so it's extremely significant. Now we can try to use it with the only actually established and acceptable asset pricing model that was published in top-tier journals so far, so the three-factor model of Liu et al., which concerns not only the market factor but also size and momentum factor. So this model already takes into account the fact that the small cryptocurrencies tend to produce higher returns than big cryptocurrencies, and that cryptocurrencies with high past returns tend to outperform those with poor past performance. But still, when we do it, we just still get an abnormal return of 2.6% per week, meaning that we have a very strong strategy with absolutely superior returns. Now, when we look at the exposure of this portfolio, it actually seems not to move with any other known factors or strategies. There's no exposure to the market factor, there's no exposure to the size factor, with only certain exposure to the momentum factor, which is to some extent understandable since we are based on the technical analysis. Now there's a problem with a lot of different strategies that they extract information from very small, illiquid, intradable stocks, but is it the case here? Now if you look at the average market capitalization or volume in our strategies, that doesn't seem to be the case. I mean, the average market capitalization in all those top-bottom portfolios is more or less the same trading volume. So it seems that the performance does not hang here on some handful of liquid stocks or liquid cryptocurrencies or a shady corner in the market. Now, to still verify further whether we see here abnormal returns comparing to what's happening in the broad market, we run cross-sectional regressions and examine if a range of different return predictive variables, controlling virtually for everything that we know from asset pricing literature for beta, size, liquidity, idiosyncratic volatility, past performance, but still we see significant abnormal returns showing that apparently the C-trend factor produces abnormal performance beyond the information contained in all those individual single variables. Now, we aggregate here 28 different variables, so how do we know which information from which of them the C-trend factor really extracts this information? I mean, how do we know that it does not maybe rely on just one or two powerful indicators? Now, to do it, we calculate the variable importance, namely like, you know, each week we drop one by one all the variables from the calculations and see what is the reduction of return predictability. And what is the most important, I mean, we have some that matter more, we have some that matter less, but it really does not hang on just a couple of different variables. We extract here information from a broad cross-section of different factors, and thanks to that, we are able to achieve this return predictability. Now, can it be used to price the market? Can it be used to explain what's happening in the market? To what extent it can be used to explain different anomalies, different return patterns, different behavior in the cross-section of cryptocurrency returns? Now, we don't have many models that we can compare ourselves against, right? We have just one actually asset pricing model that was published in Journal of Finance 2 years ago, which incorporates these three factors, which is market, trend, and momentum. So we try to compare it with this, right? So what we do, we build a mean variance efficient portfolio. So the portfolio with the best possible return to variance or returns to volatility profile. And then we juxtapose, we compare the performance of this portfolio, whether it will improve or not, if we include that C-trend factor. So actually, if you look at the third row, if we already have the C-trend factor, then including momentum does not really happen. So when we have the C-trend factor, we capture everything which is associated with the momentum. On the other hand, if we just use the three factors from Liu et al., we still can improve its performance by including the momentum. But the market is not just, you know, size and momentum. We have a lot of different anomalies that we can test. So we look broader, right? We look at all different anomalies that were tested by Liu et al. They examined 7 different they examined, I think in total 12 or 13 different anomalies. Then we look at all our individual technical indicators and we try to hit them with different asset pricing models. And specifically, starting with capital asset pricing model and then moving to Liu et al. And moving to C-trend factor. Now, so if we hit all those anomalies with the capital asset pricing model, it doesn't really seem to explain much. I mean, on the horizontal axis, you have the average returns, and on the vertical axis, you have unexplained returns, so alphas that are left after you apply the asset pricing model. If you apply capital asset pricing model, nothing really happens. I mean, you have still 20 significant anomalies in the market associated with different variables. Now, it helps a bit if you apply the 3-factor model from Liu. I mean, the number of significant variables drops from 20 to 10, but we still have a lot of them. We still have 10 different patterns that we really cannot explain, and the average alpha, absolute alpha on those strategies is like more than 1%. Now, if you apply the C-trend model that accounts for market size and C-trend, then in this case, the average alpha drops to only 0.7, and the model explains virtually all known anomalies that we have seen so far in the literature. Just 2 of them out of, I think, 30 or 35 that we have already in the sample remain significant, the 5% threshold. So the model seems to explain everything that we know so far that is happening in the cross-section of cryptocurrency returns. But how can we use it in practice, right? It's really, I mean, you see a lot of models produce 2, 3, 4% per month or per week, and in this case. But can we really use it in practice, right? Can we forge it into implementation trading strategy? So let's see, right? We look at different practical considerations. I mean, at first, a lot of trading strategies work only in those times that you prefer to stay away from the market. Only in times when the market is especially volatile, right? Or highly uncertain, or especially illiquid, or during bear markets. So then where you try to like stay away from the market. But it's not really the case. If you actually look, you see that the market, our strategy, the long-short strategy based on the C-trend indicator, produces higher, almost equal performance in bear and bull markets, regardless of the uncertainty in the market. And also it works pretty well, delivering more than 2% alpha per week in the high volatility market. So maybe it's a case of just some small cryptocurrencies, of some very small and illiquid tail of cryptocurrencies that are really untradeable, and I can show you like 2-3% on paper, but when you try to forge it and translate it into virtual trading strategy, it will all disappear. But it's not really the case. So we reproduce our strategies only in 50 or 30 or 20 or 10% of those most liquid on the biggest cryptocurrencies, or even in 100 cryptos with the biggest size or biggest liquidity in the market out of all the 3,000 in our sample, and it still holds, right? Still, the strategy produces substantial and significant returns or alphas exceeding 3% per week, which is really surprising number. But still, it does not solve the issue of trading costs. So maybe it's about the trading costs. Maybe just trading is extremely costly, implementing this strategy. So to check it, we also examine the impact of trading costs. I mean, you don't really know how much it costs to trade in cryptos because different factors matter, but we take a couple of assumptions. I mean, first, the strategies require you a lot of trading. I mean, you need to replace 70% of the portfolio every week, which is a lot. But still, given the level of the probability, if profitability, if you even assume that the trading costs are, I don't know, we assume 3 thresholds, 0.4, 0.6, and 0.8% per trade. So even if you assume that the trading cost is 0.8% per trade, it leaves you with 2.3% alpha per week, which is an astonishing number. Now, so but it's not only about long-short strategies. I mean, shorting might be not really possible. So if you look at the long-only strategy that excludes both shorting and also accounts for transaction costs, actually the performance even perform. We have more than 3% per week with a t-statistics of more than 4. Now, so it seems that we survive here a range of different robustness checks incorporating the traditional implementation problems or impediments that people may encounter, including trading costs, liquidity constraints, short selling constraints, I mean the impact of especially volatile or uncertain periods in the market. So is it too good to be true? I mean, how is it possible that this type of strategies exist, right? Now, to check it, we also run one more robustness check. Namely, we experiment with different research designs. I mean, you know there is a lot of implementations issue. There's a lot of small methodological choices you can make in this type of research to make the results look beautiful, to push them up. Now, so what we do here, we examine a range of different alternative selection choices. So rather than, I don't know, dropping the outlier at the level of 0.5% as we do in our baseline approach, we exclude all those, we insurize the returns at 1%, right? Stable cons, we include them. Minimum market cap, now it's 1 million. So we alternatively consider either no threshold or 2 million. We apply or do not apply price filter. We examine different numbers of, I don't know, rolling windows for estimating the C-trend factor. Now, assuming all those different combinations and all different possibilities, we create 50,000 different strategies, 50,000 different alternative implementation of our C-trend factors. So how does it work? It seems that still majority of all the alternative implementations produce substantial and significant Sharpe ratios, exceeding 1, exceeding 0.5, exceeding 2, even in like 20 or 30% of cases, which you do not really see in the normal stock market. So if you look at the impact of all different choices that you can make when implementing our strategy, like, you know, how you filter out the securities, how you filter out small caps, how you treat the data, how you implement the factor, how you estimate your functions, it all does not really matter. You still achieve like substantial alphas or substantial risk-adjusted returns. So let me conclude what we did in this study, right? So what we tried to do is to somehow fill the gap with the fact that we miss a proper asset pricing factor for cryptocurrencies, asset pricing model that will help us to explain what is happening in this new asset class and why there are such a big differences in the cross-section of the returns, right? Now, so we developed a new C-trend factor for the cross-section of cryptocurrency returns, a factor that extracts as much information as possible from price and volume data. And using machine learning methods, we pull this data, we pull this information and form the new return predictive variable that we test within the sample of virtually all sizable coins from the stock market for the years 2015 to 2022. Now, we find that it really predicts reliably future returns. It's robust to a broad range of considerations. It explains virtually everything which is happening and which we know that is happening currently in the cross-section of cryptocurrency returns. And it survives real-life economic constraints, meaning that it can be forged into practical trading strategies. And that was my last slide concerning this research. Thank you so much.